and is a fellow of the Nigerian Institute of Bankers. Welcome once again, sir, and thank you for being here. Our host for today remains Ade Buraimo, the Group Managing Director of Alpha Morgan Group, comprising Alpha Morgan Capital Managers Limited, Alpha Morgan Capital Advisory Partners, and MBSL. Ade is a banker with over 25 years of commercial and investment banking experience. He was the Managing Director of GT Bank Limited Sierra Leone in 2010, and prior to that, he was the Managing Director of GT Homes, the mortgage subsidiary of GT Bank, the mortgage banking subsidiary. He's a fellow of the Chartered Institute of Bankers, an associate of the Chartered Institute of Securities and Investment UK, an associate of the Chartered Institute of Stockbrokers, and a non-executive member of the Fund Managers Association of Nigeria, where he serves as the chairman, ethics, standards, and regulations. Ade, you're welcome. Last but not the least, we have George Imade, who's the Managing Director of Alpha Morgan Capital Advisory Partners, our investment banking subsidiary. You're welcome, George. And as usual, today we'll have a 1-hour session. Our speaker, Bismarck, will speak to us over the course of 40 minutes, during which I encourage our participants to kindly type your questions in the question and answer box. Your questions will be answered after Bismarck's presentation. After that session, George will give us the closing remarks, and then we will close. At this point, I'll hand you over to our host, Ade Buraimo, and I welcome you once again, and thank you for joining.
Good morning, everybody. Thank you, Doi. Thank you so much. My name is Ade Buraimo, and I happen to be the Group Managing Director of Alpha Morgan Group. I welcome you all again to our 11th edition of Alpha Morgan Wealth and Economic Review webinar with Bismarck Rewani. This is the last edition this wonderful year. Since the last webinar, a lot has happened, but of significance is the appointment of a new central bank governor, our governor, Yemi Cardoso. The governor has made some pronouncements, and I'm sure our speakers will touch on some of them, some of those pronouncements and implications on our businesses, implications on the economy, implications on inflation, exchange rates, and pricing of goods and services. I want to allow a lot of time for our speaker to speak, therefore I'm going to be stopping here. As I conclude, and once again, welcome everyone, I want to thank Mr. Bismarck Rewani for finding time always to honor our meetings. Okay, thank you so much. Thank you and welcome, sir. We also use this medium to wish everyone, all our listeners, all our friends, all our clients, Merry Christmas and Happy New Year in advance. I pray we'll see ourselves in 2024. Sir Bismarck, the floor is yours, sir. Good morning, sir.
Thank you. Good morning.
Yes,
if you give me a minute so I can share my document.
thank you so much.
Okay. Good morning. The theme of today's discussion is the supremacy of markets and the year of the global investor. We're talking about 2024. We would have a conversation around the global and economic and investment climate, Nigerian policy direction, and the difference between political expediency and economic inevitability. We would look at asset classes, from equities to fixed income to alternative assets. And then we'll look at the risks in the economy and kind of conclude where we are headed in a year, what I can consider a very tough year. What is the global investment climate as we enter the last week of 2023? all projections that we've seen point to the fact that there will be mild, tepid growth in 2024. But if you lay that against the expectations at this time last year, everybody was talking the fact that there'll be a hard landing, there'll be a recession, inflation will go through the roof, and those were the projections. But like I said, one day or 1 week is a long time in politics. I think 1 year is a long time in economics, and that's why John Maynard Keynes pointed out that in the long run, we are all 6 feet under. So what I'm trying to point out here is that between our expectations and forecast last year and what has happened so far, we see a better picture, but not great, but definitely a soft landing. Secondly, at this time last year, I think the Ukraine-Russia war had just started, I think, and it's now becoming an entrenched, stalemated war. We expect to see a decline in global commodity prices as global supply constraints ease. You see, no matter what happens in life, people find a way around it. If, for example, Nigeria was to be cordoned off today and sanctioned, the same people that are living on pork chops and ribeye steak and Sunnyside egg ups and all, the same people will start living on plantain and amala and all of that. Within 2 weeks, they will adjust. The human body adjusts to any condition. So what has happened was that because of the crisis and global supply chain problems, price of commodities went through the roof, but now people have adjusted. Some people have cut back. Some people have changed what they're doing. So that's what we are seeing. So we think that global commodity prices will begin to show some kind of decline in 2024. So that also means that ease in inflation and interest rate hikes. In other words, as we begin to stop the tightening cycle and interest rates begin to reduce in the advanced markets, we think that inflation easing first before the interest rate slow down. It is not the interest rate slow down that is leading to ease of inflation. So let's get the sequence right. Because the inflation is declining, then interest rates begin to decline. When interest rates begin to decline, the price of bonds and all that, we'll come back to how markets respond to that. Because as investors here on this call, it's important to know that we are an interest rate sensitive community. Forget about the exchange rate. Global investment, to a large extent, depends on how interest rates respond. Because what we save is what we invest, and what we invest is what we get a return. And the return is actually described as the present value of future earnings. That's what stock price is. We think that there will not be too much of a banking turmoil, maybe in some parts of the world, but definitely the way the investors and the way the regulators and policymakers are, they are so proactive and now that even at the slight hint of any crisis, they would respond and contain it. Geopolitical tension is part of the natural consequence. If it's not in what we heard in the last 2 days was easing of tension in the Middle East. Now there was some people who have been killed, some innocent Israelis have been killed. But what is more important in the last 48 hours, in the last 72 hours actually, has been the marine crisis in Yemen. In other words, the Yemenis, the Yemen terrorists are using drones to attack boats, ships that are carrying commodities. So all the commodity traders are now having to have extra insurance. Yesterday alone, 10 drones were brought down, and it made it impossible for things to pass through the Suez Canal and the Red Sea. So that's another dimension which was not expected. And so in that case, even your ships that are transporting goods and now have to be insured, and many of them have said they're not going to transport things until something happens. So an alliance of 10 countries have come together, led by the United States, to ensure, and the United States Navy are all in that area, trying to bring down these drones. And the thing about drone technology is that you don't have to be there physically. You can manipulate it from anywhere you are, right? That's the danger of drone technology. So heightened geopolitical tension, but again, do not forget that the conventional warfare between Kuwait and Iraq, between Iraq and Iran, what we are seeing, except for Ukraine, which is another dimension, is that there are no two wars between two countries anymore. There are wars between a country and terrorist groups in Lebanon, in Israel, in Gaza, in other places. So when you are fighting not a country, but a radicalized group, then that has redefined warfare. Because conventional warfare, that is the other country, this is where you just want to wear this type of uniform, that one, it's no longer that way. The guys, the thing that is going to attack you is inside you yourself. So that's what happened on October 6th. And 19,000 people have been killed between October 6th and now. Right? 19,000 people are a lot. Even in a conventional war, you don't have, because before the people attack you, you would have evacuated yourselves and all of that. So 19,000 lives, innocent lives, is a lot in what was not expected. Not to talk of what's happening in Ukraine. So surge in debt burden as interest rates increase, right? That's another thing. While on the right column here, you talked about easing inflation and interest rate hikes. Now we talk about surge in debt burden as interest rate, because this actually refers to debt service by less credit-worthy clients, including African countries and all of that. Will there be increased market volatility and uncertainty? Well, to some extent, but the volatility index is actually expected to reduce. So I would say here, let's see. Sorry? Don't stop share. What to do? I want to bring this on. You can still see my stop share. That's what you did. I can stop share. Still share. I stop this system. Okay. So now I want to share it. Just 1 minute. We're trying to get some things done. Okay. So what do we take out of all of this? In 2023, the global investment financial turmoil plagued major banks across the top world countries. Financial regulators were proactive. Inflation started to decline from an 11-year high, and recession fears. We already talked about all of this. Now, we saw a lot of artificial intelligence and the guardrails in artificial intelligence and did not have the guardrails and did not have emotional intelligence, because the tools for artificial intelligence did not. But now we've begun to see that you can program them to have emotions, and to some extent, some things happen and you would have it reacts to some negative things. So we are beginning to program the robots to become as close as possible to having emotional intelligence as well. Now, we would see that intellectual property theft, the artificial intelligence being used to create, mimic things and create false what I call it, false images, and bringing nostalgic, going back to the future. All of these things have made it possible now that the entire veracity of mankind is being challenged. But we will see as we go along, you will see that people, I think over 10% of humanity is going to be above the age of 65. that the traditional retirement age and what Shakespeare said was 10, right, is no longer valid. There are more people in Japan and in China and Italy. There are more people that are above the age of 100 and are still mentally agile than ever in the history of the world. So, and that changed the demography and the demand and supply patterns of commodities as we go along. So what happened in 2023? We had all sorts of rates of return. If you invested in gold, you got, if you invested in gold in Nigeria, you got 10.23 year-to-date return. But if you think that gold is a store of value, you've got to know that gold goes along coincidentally with the dollar. So if you take the exchange rate gain in particular, then the figure of 17.97 is not valid. The real rate of return is much more than that. S&P 500, you got 23.4, but because the exchange rate appreciated, the Naira depreciated, you're actually getting a 58.43. So if you took your money out of Nigeria, changed it in dollars in January and went and bought S&P index, you would have got 58% return, and that's not a bad, that's a decent return. If you put all your money into the Nigerian stock market and bought the index, you would have gotten 41.24 return. If you discount for inflation of 30%, you are at about 13% return. Real estate, well, it depends on what market. So real estate cannot be taken as a general class. Depends, real estate falls into commercial real estate, residential real estate, high-end real estate, office blocks, and then mixed use, right? So I would say that generally, since real estate is a store of value, in other words, if you built your house when the price of cement was 4,000 or 3,000 and you're building it today, you're already in the money. So that's what we're looking at. Something that also has happened since May 29, when the Lagos team moved to Abuja. There's been a return of investment to Lagos because the entire formula of the Nigerian administration and the post-Lagos Abuja shift had meant that Lagos was being drained of investment and going to Abuja. Now the Lagos boys are in Abuja, and so they are clawing back what has been taken from them. So you see that Lagos has become a construction site. Everywhere there are canopies everywhere, and sorry, what they call it, these things that they use. All right, so they're there, and so you can see massive investment. Will this supply lead to a drop in prices? I'm not sure, because again, it's another hedge. Two things happen in real estate in Nigeria. One is that it's a hedge against inflation, and two, it's a vehicle for money laundering. So Bitcoin, well, it's about $40,000 or $45,000 now, depending on when you entered. If you entered 2-3 years ago, you're underwater, but if you entered in the last year, you're making money. Now, end of money tightening cycle, I said it already, the Federal Reserve has stopped, the Bank of England has stopped, the European Central Bank has stopped. We're seeing the only people that are increasing interest rates is this new lady who is the new governor of the Central Bank of Turkey, who claimed yesterday that her salary is not enough to pay her rent, so she's moved back to her parents' house. So one can imagine what to do. But inflation in Turkey has got all the way to 61%, and the currency is better. But again, we're doing the wrong thing for such a long time. Now they're going to take corrective measures, and there we are. But Turkey remains a very solid economy due to also many reasons. Chinese are rebounding, and again, a lot of big numbers. Before they used to grow at 7-8%, but now they're doing about 3-4%. And what I noticed also is that the Chinese loans to Africa are beginning to decline, and they're going to put in pressure on African countries who cannot repay. So this is what we are looking at. The World Bank thinks that 2024 we will have 2.4% growth, but definitely no negative growth across. So the fears of recession are permanently thrown away. But again, in economics, anything is possible. anything is possible. Don't forget, the year ahead holds a lot of things. So other trends to watch out for in 2024. Stress testing to ensure that the world does not fall into what happened in 2008 and does not fall victim to what happened in Silicon Valley Bank. So the world is changing, expectations are changing. Artificial intelligence is making it easier for people to know things and even to project. ChatGPT and what you call them, Siri and all of that are now making it possible to. It has its positive views in terms of getting information, but it also has negative views because those who are forging documents and hacking, and so the threats of technology, the amount of money that is going into negative technology developments is much more than the amount of money going into the creative side of things. Now, what do we see? We see renewable energy consumption 2024 will climb by 11% to a new high. But fossil fuels, that's oil, coal, and others, will still produce 80% of energy demand. We are told that 1 in 4 new cars will be electric vehicles, with more than 50% of them sold in China. China last year had 15% of electric vehicles, but now we are seeing it go as high as 50%. But what I want to remind you, 2 years ago when we had this webinar, remember that the price of second-hand cars were more than the price of new cars, because COVID, all these guys were not working from home, and so they stopped producing new cars. So those who had bought cars and couldn't use them because of COVID were selling those cars at a premium, right? And that became the real thing. Now, in developing economies, mainly Nigeria, Algeria, and South Africa, we are beginning to see that, even though central banks are going to cut rates, the loans and the credit premium, credit risk of developing countries remain elevated. So you find that even though Nigeria now has positive outlook because of Moody's, you will see that its credit rating still remains 6 points low in the junk category. So what's going to happen in developing countries? We're going to be relying more on domestic debt market. What does that mean for Nigeria? Domestic debt markets means that interest rates increase and bond prices will drop. And if interest rate increases, the debt service of the government is going to increase. The government is, to put it mildly, confused as to what the next steps should be. Well, there's a structural shift taking place in the global economy, primarily due to constant shocks. But the point is this, that most of the developed countries have already overdeveloped. In other words, there's no space to build new roads in Europe or in Japan. The road between London and Manchester, you can't build another one. It's being well maintained. All you can do is expand the road, right? While in Nigeria and African countries, you need to build new roads, because those roads were, the road network of Nigeria was built in the colonial times. And if you see, there's nothing like east-west roads. All the roads are north-south. In other words, you develop your granite and cotton in Kano, and it comes all the way to Port Harcourt or to Lagos so that you can ship it out. There's no road that goes from Makurdi to straight across to Kirby, because they don't expect you to trade amongst yourself. The ships, the Europeans came here to buy slaves, buy raw materials when the Industrial Revolution, when they didn't need the slaves anymore, and did that. So that structure still exists 200-300 years later. So now it's only now that you begin to think about. Just think about it. If you are going from Enugu to let me say Lokoja, there's no road that goes across. Right? You have to come all the way, either go to Abuja to go this way. There's nothing. So, and is there trade between Makurdi and Lokoja? Yes, but there's no road to go through. So I'm just trying to tell you that the infrastructure gap in the developing countries totally different from those in the developed markets. So central banks are in a difficult position. So because we have limited time, let's go straight. Global investment, slowing economy, possible recession have eased, positive operating leverage. Investors are expected to deepen their positions in securities. But I want you to know something. During COVID, two things happened. One, we're stuck at home. Two, for those who were stuck at home, they were being paid to stay at home. They're being paid to go to bed, right? And they started working with that from home, virtual working. Now, what that meant for the people who were working, I went to Miami once when it started, and the guy who was driving the taxi told me that he's on paid for doing nothing at home, and now he's driving a taxi. So he got double pay at that time. In fact, triple pay. Was doing other things. It was as a waiter in one place, as a driver, and it was as a civil servant. So he was getting paid. So what it meant was that there was a massive amount of savings. So what did they do? When all those things stopped, the follow and all that stopped, they now started spending their savings. So you saw a surge in consumer demand, which pushed up prices. So what we said, the unleashing of savings into consumption first, right? Then followed, then extra demand. The extra demand has led to an expanding supply. But sales law says every supply creates its own demand. But in this case, the demand, aggregate demand increased. First of all, cash that was the unleashed savings into consumption. Consumption, of course, meant extra demand. Extra demand meant you needed to expand capacity, right? And that supply followed. And that the increase in supply means need for more investment. Okay, so we've gone full cycle from 2 years ago. I think COVID ended 2 years ago, right? And now we've seen the full effect. We've had inflation because of the cash release. We've had interest rates being squeezed to bring out inflation. We are now seeing that surge of an expansion. So 2024, 2025, we're going to see that slow growth in expansion. So as an investor, you begin to, and that's why this title was Supremacy of Markets and the Year of the Global Investor. That's what we meant. So U-shaped, I'm not too sure. Yeah, U-shaped is probably possible, but I think that the recovery is going to be a slow. You're going to have it recovering slowly but consistently. You're not going to have a downturn. Well, we talked about geopolitical, so let's leave all of that. So where does this leave Nigeria? Nigeria is becoming more integrated with the global economy. Nigeria needs to borrow. Nigeria has to reschedule its debt. Nigeria needs new money. Nigeria needs to align its currency with market reality. And the low end of US interest, Nigeria cannot afford to default as a country. Neither could any of its banks with their Eurobonds even contemplate a default. And the only way not to default is to ensure that you put your money where your mouth is. To do that, you need investments. To get investment is a function of confidence. Confidence is a function of truth. Truth is a function of integrity, and that's where we are. So, first of all, I do not think Nigeria has never defaulted. Will not default. What they do is issue promissory notes. The promissory notes are sold at a discount, and those who have the courage to take it will do that. So, what is Nigerian policy and economic environment going to look like in 2024? We think that in 2024 we'll see a growth rate that will increase. All right. We think that potential GDP also shows that potential GDP is higher than real GDP growth. So that is, in my judgment, it's a red line there, not a blue line. GDP per capita is declining, yes, because in real terms, Nigerians are getting poorer. And there was an article yesterday called "The Problem in Global Growth Depends on Africa," and that's where they said Algeria, Nigeria, South Africa. And that even though we have a problem, and that was written by Ricky Schumer, the guy who wrote The Breakout Nations. And you have to take him very seriously when he talks. Total factor productivity is positive, which means that those assets that were completed, projects that are completed, are beginning to generate a higher rate of return. And quite frankly, I understand that there are 97,000 uncompleted projects in Nigeria, uncompleted assets. So if you can complete even 10% or 20%, which is maybe 20,000 of those projects in the next 4 years, you can increase productivity substantially, right? So there are bridges that have been built and left hanging, they are not completed. And half completed bridge cannot do anything except you want to go there and use it as a diving board for diving into the river, right? So it doesn't help you, right? So a road that is incomplete and stopped in the bush, nobody lives in the bush, nobody. So all those kind of things are. So is there an opportunity there? Yes, there's an opportunity. If you go and buy that incomplete bridge from the government or lease it, complete the bridge, and then people now know that they can go from one end to the other. There are many parts of where I come from in the Warrior area. In those days, we go with boat. Takes us about 4, 5, 6, 7, 8 hours to go. And today, those bridges, when they're completed, that journey of 8 hours takes about 10 minutes. So I want you to imagine what productivity means in that. And there are many like that all over the country. What is our fiscal situation? Our fiscal deficit is reducing from 6-7% of GDP now to about 5. Even we target to make it 4, and that's significant, and that's federal. But if you look at the deficit in the states, all the states are running a deficit number which is much higher than the previous year. And I think yesterday they announced they're sharing about 1 trillion, 1.03 trillion. 1.08 trillion for fact. So we've seen it go all the way to 1.9. Now it's 1.08. What are the state governments doing with the money? That's another story altogether. Current account balance is improved, or is going to improve. Trade balance is going to improve significantly. And exchange rate, that's a question that we'll look at. But today, the official exchange rate is about 840. We think in 2024, the official exchange rate, if there's some kind of convergence, will be at about 900, 950, maybe 1,000. But before it gets to 1,000, it probably go to as far as 1,350 naira. Things go in that direction. The politics of Nigeria, the time in office, the president has found out that politics of Nigeria is much more complicated. And getting to office, getting to power is one thing, but staying in power and keeping people happy is another thing altogether. So can he proceed with market reforms that are on a very thin mandate? Or does he just compromise and say, okay, look, forget it and same old? That's the big question. If you want to make a difference, you have to make a difference. But to make the difference, you need to carry everybody along. To carry everybody along means that investors and everybody have to be able to make a sacrifice. Sacrifice starts from the top. The last man to leave a ship when it's sinking is the captain. If the captain takes off first, and you can imagine what will happen in the ship. Everybody will dive into the water. So, but that's the rule of the ship. Your captain leaves last, right? So, and when it's good, the captain gets the merit last. The people get. So that's the thing. The political issues are much more structural and much more institutional, because when you have, just look at what's happening, generally speaking, everybody was excited in June that, okay, subsidy is going on and all of that. And if the problem was really subsidy, by now we should be seeing some benefits. I think people are saying, please take us back to where we were before, right? Which is 1. 2 is that remove the subsidy in petroleum, remove the subsidy in exchange rate. The assumption is that the government that will have it will spend efficiently and create growth. But that's not happening right now. So people are beginning to ask questions. What the hell is this? Who are the advisors on this, right? So, but that does not mean that the economy is not going to grow, because there's a natural rate of inflation and some things. But the understanding this and being believed is the key thing. What the politics that you are seeing very, very unsavory developments in Rivers State. Kano is just ticking away. And so when you have the two ends of Nigeria, that is one in the rivers where it's very volatile, and in Kano, which is extremely more volatile, right? And those are in political trouble. Then Zamfara, and the politics that actually means that politics that people, the arbiters of political disputes, which is the judiciary, are not necessarily believed. So these are the things that raise doubts as to how. But one thing is clear, that the political situation cannot and must not be allowed to deteriorate, because if it deteriorates, then there will be a problem. Therefore, both those who are opposed, those who are for, and investors for that matter, have a responsibility to ensure that the house remains intact and that the reforms are tweaked in a way that we get what we call the theory of the second best, right? Where the perfect option is an ideal type, but the next best is one that keeps everybody. Because when you try to reform, you can reform and make things worse. And that becomes a very, very difficult situation. So I want you to understand that in the end, the political decision and direction, followed by a policy direction that reinforces that political goal, followed by supervision of that with the markets, and followed by enforcement of all those things go consistent. So we say and we believe that there's hope, right? Hope is not a strategy. So there are flickers of positive things that come, but only if it coincides with hard work, heavy lifting, and technocratic thinking. And I think that's what failure to do this will entrench poverty, and what you don't want are those three types of crisis. One, a class war between the poor and the rich. Two, a sectarian war between radicalized different religious feelings. And finally, ethnic wars. Because if the fault lines fall along ethnic and religious, and then poverty, and not just poverty in pecuniary terms, poverty of opportunity, right? So now, what are the policy imperatives? The policy imperatives are this: whether we like it or not, the central bank governor made a statement. I think Ade Brahimo referred to it. He made a statement very clearly. He made some very, very important statements. But also, the things he did not say were probably more than the things he said. So, and we'll come back to that in a minute. It referred to bank recapitalization and the reason for it, right? It talks about going back to orthodox monetary policy, talked about the 5 functions of the Central Bank of Nigeria, which include exchange rate management and all sorts of things. In the fiscal space, we talked about increasing revenue, elimination of subsidies and all of that, minimum wage review. There are 2 different things. There's a wage review for everybody and a review of the minimum wage. Minimum wage means you take the bottom up and leave all the others where they are. But that's not, we've gone past that, right? So, privatization, debt rescheduling, all of this is a cocktail of reforms. But these reforms are not consistent with the oligarch structures. You cannot reform to the benefit of only the haves and without the benefit of the have-nots. So, CBN has said price stability, blah, 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 lack of independence. So there are risks, but generally speaking, let's go back to what the central bank is saying. Central bank is saying, one, we need to study the transmission mechanism. He made that comment about 4 times, and I listened to that very clearly. The transmission mechanism for money supply aggregates. He said, we are going to embark and use what we call the explicit inflation targeting framework. So let's take it one after the other. 1, transmission mechanism for money supply, which means that money supply in different components, right? And the effect of this money supply on general prices, right? So in economics, we have what they call narrow money, broad money, blah, blah, blah. But in the context of all this, we have what they call high-powered money. High-powered money is money which is created by government activity. Right? So if you have a deficit, you know that. So that itself, high-powered money is the major transmitter of prices. Then monetizing the credit. When the central bank talks, they talk about credit to the private sector, credit to the public sector. That credit to the public sector, right, when it is monetized, becomes high-powered money. In addition to that, we are now beginning to see other forms of money. Where the time of Keynes and time of Friedman, money was very clearly defined: cash, bank deposits, right? Credit, and that was it. M1, M2, M3, right? That was all. And then if this increases, the consumer price index increases, period. What are we seeing? We now have pseudo monies. We now have credit card, mortgages, and all blah, blah, blah. And instead of money, and all that time money supply was growing in the West, we saw a very high level of inflation. Why? Because they had asset bubbles. So that inflation, rather than being in consumer basket, came out in a form of asset bubbles, right? So stock markets were rallying, and people were spending that stock market money. So that increased money supply and the velocity of circulation. After a while, the chickens came home to roost. Then there was a collapse. Collapse affected the banking system, and that's why I'm telling you that this. So Cardoso said, transmission I'm going to study. 2, I'm going to do orthodox monetary policy, which means that I will stop doing all this intervention madness, right? But before then, let us interrogate what he meant by inflation targeting. He announced inflation targeting as the framework without telling you the target. So let us assume that the whole target is still there, 6 to 9%. So take 9 as upper. At 9%, and inflation now is at 29% more or less, is 20% above. So in terms of range analysis, right, you have 75% of the range, right? If 0 is the beginning of the range, right, and 30 is the range, and then your target is 10, and then you've gone 66% to 30. So in real terms, you have actually increased prices of 66% more or less. Now, what does he want to do about it? Said that we need to tighten, and we need to, but at the same time, at the end of the speech, he said, "Oh, we need to make credit available to small, medium scale, and others by making them affordable, credit affordable." One, there's something. So I think that was talking for the market, but the reality is that Cardoso is going to use traditional tools to bring the market into equilibrium. All right. Then 3, he talked about market recapitalization of the banks. Well, it's simple. In 2004, we had 25 billion naira as minimum capital. That time the exchange rate was about 118. So now that means you need, let us say for sake of argument, you need $20 million, not $25 million. What is $25 million at 1,250? It gives you almost something around almost 0.3 trillion, about 300 billion. But 300 billion, if you look at the total asset size at that time, when in 2004, the asset size have multiplied, total assets of the banks multiplied by over 15 times. Therefore, what was adequate minimum capital in 2004 is no longer adequate. Even if you told all the banks to go back and capitalize themselves to $25 million, they will not be able to carry the balance sheet they are carrying today. Those banks have grown rapidly. So the capital requirement of those banks is much more than you thought about. Okay. So now, if you look at the banks as they are, unencumbered shareholders' funds, that's different from market capitalization, mind you. So 1.9 trillion naira Zenith Bank, 1.7 trillion naira UBA, 1.37 First Bank, and GT 1.2 trillion. Then you have Stanbic IBC and all of this. So if you say that it's 300 billion, which is the minimum capital, and when we talk about minimum capital, not just shareholders' funds, we have tier 2 capital and all those other hybrids of shareholders' funds. So we think that whether we like it or not, there's going to be capitalization. I think yesterday FSDH announced that they're converting from merchant bank to commercial bank effective January, whatever it is. So what the large, I think Nova Bank also converted from merchant to commercial. What I see is that the banks, there's a liquidity issue. They want access to the discount window, trying to get out of the CRR trap, prepare themselves as national banks, regional banks, and so on. And all of them have gone to the holding company structure so they can do everything the others can do, but at the same time, there are risks that come with this whole thing. But the fundamental rule of the term is that the Central Bank of Nigeria does not have the resources to intervene in a major banking crisis. Would there be a banking crisis? Not likely, because one, there's regulatory supervision, there's policymaking, proactive thinking, and thirdly, people have learned their lessons. We hope that they've learned their lessons from the past. Like they say, where I come from, if you've been bitten by a snake, when you see a thread, you jump. Okay. Now, so consolidation is inevitable, and it's going to be much more aggressive, but not as bad as last time around. But also the delineation between types of institutions. You know, they have the fintechs, there's this, there's the payment, there are switches, there, and what we are seeing, and that is, you know, what we're seeing is totally different from what it used to be. The reason why banks are going from merchant bank to commercial bank is because they want to issue checkbooks, they want to go to the clearing, they want to have access to the window. But how many people go into a banking halls today? How many people have checkbooks today? Payment systems, right? And the difference between purchase funds and non-purchase funds in the banking system is minimal. So I do not know what is driving that strategic shift, except there's something that maybe been a long time I was a treasurer, so, but the thought process still remains the same. Now, let's look at fiscal policy in 2024. We are going to be more raising revenue, but raising revenue is not the answer. It is bringing investments and the joint venturing between federal governments and private sector in terms of productive activity. So we need to bear that in mind. So we expect positive growth. We expect, and again, there's real GDP is 3.3, potential GDP 4.9. There's a recessionary gap there. Now, we are the sectors that are going to win. Why? Manufacturing and trade. Dangote refined products to begin in January. The second loading have come. Could drive productivity in other sectors due to improved energy security. Construction is a big one. Construction for civil works, construction for real estate, construction for adaptive reuse, construction for mixed development, and construction as a vehicle for money laundering. Telecoms, fantastic. Here we are, because telcos increase people's productivity, whether we like it or not. Streaming, artificial intelligence, blah, blah, blah. But telcos create unemployment of the highest order because of displacement effect. Today, the number of newspapers, I think Punch has the widest readership. Punch has about 95,000 printed copies every day in a population of 200 million. 95,000 means that one man, one paper to about 100 or 200 people, right? And you see, if you go under Falamo Bridge, you see people who are browsing. I think you pay 10 naira to browse, right? Right. Yes, pay 10 naira to browse for 10 for a few minutes. Read the headlines. So you see all the people under the bridge by the vendors. They are browsing and paying for that. So that's technology, because you can go online and read all the newspapers. So you don't need to go under the bridge, under the sun to browse it. Financial services, integrated financial services, market-driven economy, and so many things. We are now beginning to see it. Collective investor schemes in Nigeria are now growing at a compounded average growth rate of 99%. In other words, they come from about 500 billion to almost 2 trillion naira of collective investor schemes in a matter of the last 2 years. So that's where Alpha Morgan and others, they are the ones that have these collective investor schemes, and that growth rate. So people are switching from investing in real brick and mortar to financial instruments. Those financial instruments, because they don't have the skill to understand it very well, they are now relying on funds. Those funds are managed by groups like Alpha Morgan, and that's why they're doing so well. But the upside of it is very good, because the investment as a percentage of GDP in the country is still very low. You can't even begin to compare. If we are just to grow that at that compound average rate of 100% every year, we should be seeing collective investor schemes in the neighborhood of about almost 10 to 20 trillion in the next 3-4 years. And you just imagine the fees on that for those who are managing it. So there's a lot of potential there. The downside risk to growth and higher costs and squeezed margins, lower sales, and aggressive tax collection. Inflation outlook, very important. You see inflation declining. EIU also says it to around 17% in the next 2 years. Is it possible? You saw in Ghana, it went all the way from 52% to 26% in a matter of 12 months. Their currency has also appreciated. So don't think that what goes up will go higher. These things go down at times. What do we see? Where is the naira likely to settle? Well, the reality is that we think it settles around maybe 900, right? But after certain things are done, higher interest rates, mobilization of savings, rescheduling your debt, meeting with the IMF. If you do all of these things, you can come in at about 900 in another year, or 850. But using simple calculations, it shows that fair value is about 810, I think. And this is where the money comes from. 2024 looks better than 2023, and 2025 will actually begin to stabilize because they're going into an election cycle again. So equity overview, we think that the Nigerian stock market, I think the Nigerian stock market is going to ease up a little bit. Some of the stocks are overpriced, and so they need to go through an adjustment process as we go along. So there's no point looking at the past. What we're saying that look at the stocks, look at those companies that are interest rate sensitive, look at those companies that are exchange rate sensitive, but more than anything else, those companies that can benefit from privatization of enterprises and the public-private partnership. So if you are looking at PW, Julius Berger, and others, look at those who are selling iron rods, those who are selling cement, because all of those companies, just by privatizing the Lagos Ata Road, Lagos Abeokuta Road, Benin Asaba, Shagamu to Benin, just Ekpe to Ijebu-Ode. If you take that alone, the trucks that will be coming to carry refined products from Dangote's refinery, and if each of those ones pay, I think the targeted levy is 2,000 naira per big truck and 200 naira per car. If you have those concrete paved roads all the way from Ekpe to Ijebu-Ode to Shagamu, and then from Shagamu you go, I want you to imagine what is going to happen, what kind of business imperatives. Those who are selling toll gate equipment, there's so many things, right? So, and what does Dangote refinery bring to the table? First of all, we do not have to send our crew to Rotterdam to refine. Then when it's refined, bring it back here. So the transport costs in both directions. What does it do in terms of selling it to West African countries? There's some earnings there. But generally speaking, it's not a silver bullet that will solve all problems, but at least it helps to guarantee adequate supply and change the narrative as far as traffic into Bagada, Apapa, and all those places. Earnings will remain a function of exchange rate losses and gains, but those are extraordinary things. But what we are going to see is that companies that have factored themselves in to what I call companies that can key into the, let us take aviation infrastructure. If people that do that aviation infrastructure, the airports are well sold and managed properly, the car companies that go there, the ambulances that go there, the catering companies, the hotels by the airports, and the MROs, all of those things mean a lot of opportunities. So, stock market, that's right. Risk and summary. Well, the lag between central banks increasing rates and when the economy feels the effect is a big risk in global economy. Extension of monetary policy tightening leading to global recession, we do not think that's going to happen. Extreme weather events caused by climate change will disrupt global supply. I noticed that Ivory Coast said yesterday that the extreme weather reduced. Ivory Coast normally does about roughly about 2.4 million tons of cocoa a year, and now they're talking about coming down to about 1.8 million tons because of unfavorable weather conditions. What is unfavorable weather conditions? The Harmattan thing, and secondly, using women and children to harvest cocoa. So all of that thing is happening. But if the women and children don't harvest cocoa, what else would they do? So unemployment is low in certain amount of unemployment, but unemployment is not a choice. The way it is defined in economics is that if you're not looking for work, then you're not unemployed, right? So voluntary unemployment is not considered unemployment. But the theory of economics says that unemployment is not a choice. Some classical economists believe that it's a choice. When a taxi driver, when an accountant becomes a taxi driver, is that a choice? He's doing that because he has no, or when a doctor is coming on a car rider. So what is he on? Is he unemployed, underemployed, or is he just gone crazy? So, but if there's no demand for his medical service, then he has to do the next best thing to ride his Okada and carry a passenger. So that's part of the whole theory of. Now, having said that, how does this come back to us, right? Because we are using artificial intelligence, we are using virtual economy, we are using Jumia and what they call e-commerce. That is affecting people and chasing people. My newspaper vendor now is begging me to come and buy hard copies, but hard copies are becoming too expensive. So now, that is where I remember that because of poverty is becoming contagious, and unhappiness is also becoming contagious. And when people are unhappy, they believe anything, right? So disorderly change in sub-Saharan Africa is possible, leading to class war, sectarian war, and ethnic conflicts. Cost of living crisis spilling out across will lead to all sorts of things. We've seen what happened in Congo in the last 2 days, and so we need to watch out. We need to make sure that as financial intermediaries, we let people know that there's still a flicker at the end of the tunnel. If not, if people lose hope completely, then there's a problem. So this is the AIU scenarios saying that the risk, probability, impact, and intensity. Mr. Tinubu moves too fast on market reform and unleashes mass unrest. Probability is high, impact is very high, and the intensity is 20. So, but if he doesn't do it, what can he do? What's the option? So that's where the new money comes in. That's where the whole thing has to be put in, because if the administration does not succeed in making the economy grow, right, then everybody is going to be affected. Nobody, there's no winner in this. Social unrest forces the government to make concessions on its reform agenda. Yes. The thing is that the government itself has to be credible, right? You cannot be spending money on luxuries and having all these parties of, and celebrations and all of that whilst the people are suffering. So there's a inherent contradiction. So you must be able to rein in your people, and they must look credible. That's important. So social unrest forces make concessions, and where do you stop? Once you start giving in, right, and increasing wages, doing this, and then and start giving in for people who are stealing. So people see people stealing, people see people spending money, squandering. When you have 1,100 people going on a frolic somewhere and all that, it doesn't make people feel that it's time to sacrifice. In this country, there was forced savings of 20%, right, in this country during the war, and they're compelled, and the government issued bonds and paid it back with interest because they'll use it to buy arms for this thing, right? Boko Haram activity spreads from northeast to central Nigeria. It's a big risk, but again, are the armed forces in a position to do this? Dangote refinery stalls and continued cost of oil import increases. We know that the refinery is about to commence operation in the next 2 weeks. Corruption worsens under the Tinubu administration. Probably is moderate, intensity is well. So we don't know. We'll see. So these are scenarios that need things to be done. Summary and conclusion. Central banks in advanced economies are set to cut rates. Yes. Interest rates are unlikely to return to pre-COVID levels. The level of savings is expected to increase both domestically and internationally. Investors will allocate capital more efficiently. Global banks are expected to remain stable in spite of unfavorable economic conditions, primarily due to stronger capital buffers and proactive regulators. High interest rates and reduced aggregate consumption will subdue global growth in 2024. A decline in oil prices will affect our export earnings as well as our subsidy levels. The structure of the financial service industry will be and market change exogenous factors to drive policies in Nigeria. We are at the mercy of our creditors, but it's always good to be at the mercy of creditors because it reins you in. Federal government is likely to meet with the IMF for a policy support program. There will be rescheduling of external debt, contractual and non-contractual. Reduced deficit financing will lower inflation risk. Inflation begins to taper at the end of 2024. People begin to behave themselves responsibly because they are being forced to do it. And I think we think that there has to be a reshuffling of some of the members of the team to bring more capacity, credibility, and competence to the system. Profit in banking and financial institutions will be affected. The activity will increase, but the profit margins will be reduced because cost-to-income ratio becomes very important. Thank you very much, Mr. Brimo and members of the team. Thank you very much.
Thank you so much, sir.
Thank you so much, sir. As always, it's a delight to be able to just hear all this part and try to make sense of it. One question that I had was you had alluded to the fact that it's expected that inflation would taper down in Nigeria towards what, 20%?
17%.
Okay. Oh, 17%. But then you also said it's possible for the bubble of the equities market to burst in 2024. I'm trying to marry those.
No, I'm not saying a bust. I'm saying that the share prices will fizzle. It doesn't mean there's a difference between a bust. Let me just make that very clear so that people don't misunderstand it. Okay. There's a correction is 10%. A correction is 10% reduction in prices. Then there's something else we call it, but a crash is when it's more than 40%, right? Right. So no, a bear market is 20. So a correction is 10, a bear market is 20, and a collapse or bust is 40. I'm not saying the fizzle means that it begins to correct itself and stays there because people recycle their portfolios. I think so that we don't miss it. That's what inflation will taper to 17%, but before in 2025, not in 2024. In 2024, it will come down to about 20, 21, 20, because the federal government of Nigeria is targeting 21%, which we say is realistic, but it could come from all the way from 29 to 23%, which is not bad, right? But in 2025, it'll be half of what it is today. But that doesn't mean that price of goods are going to be half. It means that the rate at which they're increasing will slow down. Because meanwhile, you would have to increase wages, increase certain things. So we'll all be better off by 2025, all things being equal.
Okay, thank you for that clarification. Someone has a question here. Olu says it's encouraging to see a positive outlook for the economy in 2024. However, considering how connected they are, what's the assurance that politics won't kill the economy?
Politics will kill anything if it's mismanaged. And the key to politics is being credible. If people don't believe what you are saying, it's not what you are saying, it's what you are doing. So you can say all you like, but if people see you, right, it's like, let me put it this way. If you come home and tell your children that, look, things are hard, or there's a recession, they cut our salary, and therefore, you that used to eat chocolate before, you that used to eat bacon and all that, no, we'll eat Indomie twice a day, not 3 times a day, we'll do this. Then after a week, you see your father comes back and brings a new wife and say, okay, we need to. So you begin to ask yourself, okay, you were saying that we should eat Indomie twice a day and all that, but you have enough money to go and bring another wife, so please. So it's not what your father said, it's what your father did, right? If your father has now said, okay, he used to go to the bar every evening to go and drink, now he stops going there, he goes only once or twice in a week. You say, okay, you believe in that, daddy used to go to the bar every evening to go and drink and watch football. Now he's going only twice a week. Therefore, I need to cut back. Maybe I need to read harder, I need to do this. So it's not what he's saying, it's what he's doing that is. I mean, I'm not talking about individuals, I'm saying what the government is doing is what is more important, right? So the politics will depend on how credible the actions of the people, the state governors, the National Assembly, the presidency, and everybody. If we see good behavior, then we will fall in line. Or if we see
Fall in line.
If we see behavior that is questionable, then everybody to your utensil Israel.
All right, I think we can take just one more question. So there's a lot of enthusiasm and hope about the Dangote refinery and how would we ease supply in Nigeria. But being that oil is denominated and traded globally in USD, will Dangote sell his oil to Nigeria in Naira or in USD? And if it is in USD, how does that ease the challenges with
I think it's a very important. My colleague just finished on Business Morning talking about this, and let us clarify what the Dangote refinery means so that everybody understands it, because it has become what we call a white knight or Hail Mary pass, which everybody said that once it happens, futures. No, not at all. If it was that easy, the investment is $20 billion, I think roughly $21 billion. $21 billion is not going to change the fortunes of a $500 billion or $400 billion GDP economy.
No problem.
But it helps, right? It helps, but let's not create crisis of false expectation. What does Dangote mean? It means that crude oil that was going from Escravos to Rotterdam before, right? So we transport the crude oil there. Then we refine it and bring the products back. So the two journeys of going from here to Rotterdam and the other, that has been taken out. Two is that the oil that is being given to Dangote could have earned dollars, because we would have sold it at $70 or $80 a barrel. Now we are not selling it to in a world that we are using for domestic consumption, and that has been all along. So the transport cost is lower, but it's off. The refining cost is much more efficient. Dangote refining is cutting edge. In other words, for every 100 barrels of oil that goes in there, you get almost about 90 barrels of refined products. Port Harcourt 1 and Port Harcourt 2, Port Harcourt 1 in particular, for every 100 barrels of oil you put into Port Harcourt 1, you get at best 30 barrels of output. So 70 barrels are lost into just inefficient old technology. So you are gaining that loss, right? But in addition to that, you are also doing turnaround maintenance for refineries that do not produce, and everybody steals money on that, right? And so by having a Dangote refinery which is owned privately, we don't have any burden of turnaround. If there's going to be turnaround maintenance, it's Dangote's wahala and everything. So we save that. 3 is that there's a guaranteed supply of petrol, kerosene, jet fuel, diesel, and all of that. Not only for us, but for the rest of West Africa. And it also means that we will have infrastructure to pipe, because people don't transport crude and refined products with tankers. You pipe them across. So it will, the pipeline across all the way to Ivory Coast. And I was listening to something yesterday where they were talking about countries. Yeah, it was CNN. Ivory Coast, Mali, Ghana, and all these countries, they have road and rail network. You're joining them. Nigeria does not have road or rail network to any other country. Even you can try and go through Semen and see what happens to you. So those, but finally, one of the more important things that the downstream industry, downstream sector, is based and predicated on one basic assumption, that Nigeria will never be able to refine its products, and that refineries will never work. So what have we done? We've built tank farms all over the place in Ogara, in Tinkan, all those places, based on the fact that we will continue to import refined products rather than refine our products. That assumption has now fallen flat on its face. The moment we start refining here, all that infrastructure, all those tank farms cease to be relevant. Now, not only that, if you try and drive on a Friday or Thursday evening on Magodo Highway, you will see every other vehicle is a truck or a tanker, because those guys are not allowed to leave Apapa until 5 p.m. And they block everywhere, all the way down. Crime, damaging the roads and everything. Now, because this refinery is based in the Ekpe axis, all those trucks that come, all those trailers that come all the way to Apapa, causing confusion in Ikorodu Road and all those places, all those things will stop, right? So people will turn around at Ijebu, they come all the way to Ekpe, lift, and also there'll be badges that are taking it from the Ijebu water side. So it changes the dynamic of logistics, traffic in the Lagos area, and that entire industry. So it has a profound effect on economic activity in Nigeria. But I don't want anybody to go away from this call thinking that once Dangote's refinery is ready and producing, we can all go to bed and think that life is El Dorado. No, it's not. It's not a silver bullet that solves all problems.
No problem. Thank you again. Thank you once again, sir. We have to stop at this point, but I'll hand over to my colleague, George, and thank you for the amazing time we've had with you throughout the year, and I wish you a Merry Christmas and a blessed year in 2024.
Same to everybody.
Thank you.
Thank you, sir.
Thank you, Doyin. Thank you for the wonderful time we have had with Mr. Bismarck Rewani. It's been an awesome time. I want to first begin by appreciating God who has made this event possible and successful. I would like to warmly and heartily appreciate Mr. Adebrahimon, our chief host, who worked tirelessly to ensure that this program remains what it is. He ensured that this program is evergreen, and his consistency to host this program knows no bounds. And on this, we are most grateful to you, Mr. Adebrahimon, for all you do to ensure that we benefit from all that you are also doing, and the society is better for it. Thank you so much. You all agree with me that we have had enough information, preparation, and education that will help us to navigate the next months or the year ahead. Given the volume of information received here and all that has been said, to be able to encourage us and prepare us and take our positions as to be able to tap on the opportunities that lie ahead. And that comes from no other person than our Bismarck Rewani. I call him Prof, and he delivers it professorially. Mr. Rewani, we are grateful to you for always granting us access to your fountain of knowledge, and we benefit from this to help ourselves individually and to the country at large. We are not taking it for granted. You are most welcome. I know you are a friend of the house, and you're always there for us to tap on your knowledge. Thank you so much. The last but not the least is our audience of inestimable value. Your active participation, your questions, today's question, deluge of questions is so many that Doyin could only take a few of them. But I want to assure you that your various questions and the insight you bring into this conversation and this discussion has helped to shape and reshape each edition of this program so that the last edition is always better than the former. We thank you so much for your interest and for staying with us all the time to ensure the success of this program. On this note, ladies and gentlemen, we'd like to draw the curtain and bring this program for today to a close as we look forward to another exciting edition of this webinar. I want to join the numerous team of Alpha Morgan to wish you all Merry Christmas and Happy New Year in advance. Thank you for being there for all of us. God bless you.
All right. Thank you, sir. Bye.